In this video, we'll continue the accounting terms. So let's start with the liabilities. Now, what are the liabilities? Liabilities refers to the amount that a business is going to pay to outsiders. For example, I'm taking a loan. So the amount is to be payable in future. That amount is my liability. Similarly, business has some liabilities because the amount is payable in future. Liabilities of a business can be further classified into two categories, current liabilities and non-current liabilities. Now, the difference between these two is based on the time period. So, the current liabilities refers to the liabilities that are payable in a time period of 1 year. These are short-term liabilities of the business. Current liabilities consist of following aspects that consist of accounts payable. Now, accounts payable consist of creditors and bills payable. Who are the creditors? Suppose X is selling goods to Y. X is the seller and Y is the buyer. Y has to pay certain sum of money on those goods to X. If the goods are sold on credit, Y is supposed to pay the amount to X in future. Now it raises the liability of Y towards X, due to which when Y records this transaction in his books, he will consider X as his creditor because it is his liability to pay the amount of goods to X, that is that he will be paying in the future. Now, another term, bills payable. As we discussed bills receivable in earlier video, now what are bills payable? Take the similar example, X is the seller, Y is the buyer. Now, when the goods are sold on credit, X can issue a bill. Now, that bill will be accepted by Y. He signed that bill, and on this bill, he is giving his acceptance that he will pay the money to X on a stated date in future. Now, this is the liability of Y towards X. Now, this will be considered as bills payable in the books of Y. So these are creditors and bills payable. Besides this, if there is any loan which is payable in a time period of 1 year, is considered as current liability. Now, beside this, there is a term called unearned revenue. Now, what are unearned revenues? Now, for example, we received advance for the goods to be delivered in future. Now, we received money in advance, but the goods are to be delivered in future. Now, this becomes our liability towards our client because we will be delivering the goods in future. Now, this will be our liability and considered under unearned revenue. Other than this, there can be certain outstanding expenses. Now, what are outstanding expenses? The expenses that are due but not paid yet, that are payable in a time period of 1 year, are considered as outstanding expenses. This can be anything like rent or electricity bill or any salaries or wages that are yet to be paid are considered as current liability. The other category of liabilities are non-current liabilities. Now, what are non-current liabilities? These are the liabilities whose time period is more than 1 year, because we will be paying this beyond 1 year are considered under non-current liabilities. For example, long-term debt. Any long-term loan that a company takes and the money is payable in many years, it covers many years. So this will be considered as non-current liabilities. Now, the other term, capital. Now, what is capital? Any amount which is invested by the owner in business is considered as capital. Now, this is also recorded as a liability when we will prepare the balance sheet. This is covered under the liability side. Now, why it is considered as liability? Because business is considered as a separate legal entity in the eyes of law, due to which this amount becomes the liability of business towards its owners, due to which it is considered under the liability side. Now, there is another term that is connected to capital, which is known as drawings. Now, what are drawings? Drawings refers to, in case of any personal requirement, owner can withdraw money or goods from the business. And this is known as drawings. This amount of goods or this amount of money which is withdrawn by the owner for the personal use is considered as drawings. Now, the next term refers to expenditure. Expenditure refers to the payments that are incurred by business to acquire assets or goods. Nature of expenditure is long term because the benefits that will arise from these transactions would cover the time period of long term. Now, these are also of two types. There are certain expenses that are covered under capital expenditure, and there are certain expenses that are covered under revenue expenditure. Now, what are capital expenditure? The payments that create an asset that helps in a business to attain the assets that will provide benefits to the business for a long run are considered as a capital expenditure. Like, for example, we are purchasing any equipment or we are improving the current framework of assets. Like, we are expanding our business, so we are buying another shop or another place for the business, or in case of any intangible asset is acquired. These are all covered under capital expenditure. The another category of expenditure is revenue expenditure. Now, in this, company is spending to acquire short-term benefits. Like the expenses are done to manage the regular operations, but the benefit of these expenses would also consist of a certain time period. For example, if we are repairing any equipment, the equipment is repaired, the expenses is covered under revenue expenditure, but the benefit will be attained in the following years. Other than this, in case of maintenance, we are paying money for the maintenance of business. This is also covered under revenue expenditure. And in case of any license fees is paid, this is also covered under revenue expenditure. Other than this, there is also another term, deferred revenue expenditure. Now, this is the payment which is made in advance, but the benefit in terms of goods or services will be received in future. We discussed a term prepaid expense that sounds similar, but the difference is related to the time period. The benefit of prepaid expense can be gained in similar accounting period, but in case of deferred revenue expenditure, there can be distribution of benefits in several years. For example, advertisement expenditure, the expenditure which is done in one accounting period, but the benefit will be gained in several years. Similarly, research expenses that are done in one accounting period, but the benefit will be gained in several accounting periods. So this will be covered as deferred revenue expenditure. Now, the next term is expense. Expense that the cost we pay to manage the daily operations or activities of the business. These are the expenses that are necessary to continue the day-to-day activities. For example, if there is a manufacturing concern, they need raw material to manage the production. To make the ongoing activities work, they need raw material. So the cost of inventory is an expense. Now, there are various types of expense. The first one are direct expenses. The expenses that are directly associated with production are considered as direct expense. For example, there is a manufacturing concern, they need raw material for the production. So the cost of inventory is considered as direct expense. Other than this, wages of labor, electricity bill of factory, rent of factory, all the expenses that are directly associated with the production are considered as direct expense and are covered in trading account. Now, there are certain indirect expenses. Indirect expenses are those which are indirectly related to production. For example, there are certain administrative expenses like salaries of employees, rent of office, electricity bill of office, depreciation are all administrative expenses are considered as indirect expense. Now, what is depreciation? Another term. The reduction in value of asset due to its regular use is considered as depreciation. For example, when we buy a new car and we sell it after many years, it does not generate the same value because it is reduced due to its usage. So the reduced value is known as depreciation. Similarly, in a manufacturing concern or in any business, their assets, the value of the assets reduced. The reduced value is considered as depreciation and is covered as an indirect expense. Another indirect expense can be selling expenses. Now, selling expenses that are related to sales, for example, advertisement, sales commission, salary of sales personnel, rent of warehouse, insurance of warehouse, delivery, repair of delivery trucks, these are all considered as selling expenses. So these are the types of indirect expenses. Now, the another term is profit. Profit refers to the income that a business generates from the activities. There are two types of profits, gross profit and net profit. Gross profit refers to the profit that does not cover the indirect expenses. So the formula to calculate gross profit is revenue minus COGS. COGS refers to cost of goods sold. Now, how this cost of goods sold is calculated? It is calculated by applying the formula as opening stock is plus direct expenses less closing stock. Now, this is the formula to calculate gross profit. There is another term called net profit. Net profit refers to the profit that a company gains by deducting all the expenses. So, the formula to calculate net profit is gross profit less indirect expenses. Now, there is another term called bad debts. Bad debts refers to the amount which is due but is irrecoverable in nature, due to which it is written off in the accounting period. So bad debts refers to the amount that is due but cannot be recovered. So these are considered as bad debts. Now there are another terms, debit and credit. Debit and credit are two sides of an account which we discussed earlier. Debit is considered as the left side of the account and credit is refers to the right side of account. So these are the important terms related to accounting.